I know, hard to hear it, but the market isn't reacting to our stops. Not my stop, not your stop. Much rather, it's just feeding on it. The mechanism is liquidity extraction through stop clustering and dealer hedging flows. That's not the same thing as stop hunting. Most traders think price moves because of news, because of fundamentals, or because of momentum. And that makes complete sense, right? That's what we've been taught. However, it doesn't. It moves because liquidity must go somewhere. Liquidity must transfer. Like the first law of thermodynamics, energy cannot be created or destroyed, it's just transferred. It moves because it has to move. And your exit is part of that transfer. You feel hunted, we feel hunted, I feel hunted because you are trading inside of a structure that mathematically requires weak hands to exit before the expansions can actually begin. Now that's not emotional, although it's heart-wrenching sometimes. It's just mechanical though, in reality. And by the end of this video, you'll see exactly where that pressure leaks. So let's start off with a relatable story. Something that all of us new traders, all of us experienced traders, all of us veteran traders have probably experienced once upon a time. It goes like this. You mark the level. You see the previous low, it's a clean structure, a perfect setup. You risk your 1 to 2% because that's what you've been taught to do. It's stood by you, it's done you true, it's done you well for this long period of time. You tuck the stop just below the 1% stop level. It wicks through by 3 wicks, 3 ticks, and you're out, just like that. You've followed your risk management, you've followed your procedures, you've followed market structure, you've followed price action, but you've been stopped out. But what happens immediately next? It rallies 2% without you. It goes on to the best move of the week or of the month or of the day, just below your stop. And you're sitting there thinking, that can't be random. Surely that's not random anymore. And it's not random, you're correct. There's no such thing as randomness in this market, especially when it comes to your liquidity and to your stop levels. It's not personal either though, that's the thing. Although the reality sucks, although the reality is hard to digest, it's actually not anything personal. You didn't lose because you were wrong. You didn't lose because you were misguided. You didn't lose because you didn't study the market properly. You lost because you were, unfortunately, predictable. And predictable is like liquid oxygen in these markets. Let's listen to some uncomfortably hard stats. Across regulated CFD brokers and other FX brokers across Europe and the United States, the disclosures consistently show the same thing. 74 to 85% of retail accounts losing money on a regular basis. And that number barely changes through the years, it barely changes through the decades, it doesn't collapse during bull markets, it doesn't improve in low volatility regimes where volatility is being suppressed, it remains structurally high all of the time. That's not because retail traders are incapable. By no means. Retail traders are some of the most ingenious, innovative, smart, good-thinking traders I've ever met in my life. It's not because of any of that. It's not because of a lack of ability or skill or competency. It's because retail traders happen to just cluster risk at visible technical levels. And it's something to do with our behavioral psychology, our basal ganglia, our amygdala, and we all seem to do it. Markets are auction systems. Auctions require counterparties, obviously, and the large players cannot build their size in thin air. They can't trade with a small counterparty. They need the stops. You are not trading the price in that scenario anymore. You are trading against the liquidity demand of the big players. And for anyone who tells you that they don't hunt stops, it's true, they don't hunt stops. They definitely do look for liquidity clusters, which is where retail traders psychologically tend to place their stop orders, which then goes on to lead to a face-tearing rally of 2 to 3%. So the mechanism is clear, but sometimes it's not clearly explained. But here is how the sequence actually goes. It starts off a big algorithm or a big player, a big whale looking for a liquidity pool. There's hedging involved, there's volatility expansion, and then there's the subsequent move. But let's unpack those parts a bit more slowly, right? Stops are market orders. Market orders cross the spread immediately. When multiple stops cluster at the same level, a sweep triggers simultaneous market orders. It's just the mechanics of the market. And that creates something. It creates a temporary imbalance. And imbalances, just like vacuums, they're absolutely abhorred. So if dealers are short gamma at that moment, and dealer flows really matter in this market, they must hedge in the direction of price. It doesn't mean they believe in the price going that way, or they've checked the fundamentals, or the narrative is propitious in such a way that they think, hey, I'm going to go that way. It's just that they're hedging themselves in the direction of the price. And obviously that exacerbates the move, that accelerates the move. And once liquidity fills and dealer hedging stabilizes, the real directional order flow can actually assert itself. So you think the move starts after you exit. In reality, the move cannot start until after you exit. And that's how it really works. You're not wrong, you're just the inventory. You're not wrong, you're just on the other side of a big order flows trade book. And that's how it really works. It makes it feel like, hey, they're stopping me out just at that point. They're hunting my stop. But in reality, it is the stop that allows the move to propel itself onto the next rally or the next collapse in the opposite way that you were positioned. Look, don't take my word for it. Let's use some historical parallels. 2010 flash crash. 2010 May 6th, I believe it was. The S&P dropped nearly 9% in a day. Intraday, 9% S&P. Roughly 1 trillion in market value was temporarily evaporated. Over 20,000 trade orders were completely cancelled. But what happened? A large sell algorithm hit thin liquidity. As the biz disappeared, the stops cascaded all on top of each other, catalyzing one another, accelerating one another. High frequency firms then had to pull their liquidity, order book depth collapsed. This wasn't just a panic. It wasn't just a moment in the market that everyone thought it was going to be another Black Monday or a Black Friday. It was mechanical. It had to happen in that way because the market is structured in that way. Thin liquidity means stops get triggered, market orders get overwhelmed, and then a vacuum is created. And nature abhors a vacuum. So once the cascade exhausted itself, and it always does, what happens to price? Of course, it rebounds sharply. But why? Well, because the forced liquidation was completed. All of the stops that were there got triggered, all of the buy orders got resolved, the imbalance was completely solved. The liquidity transfer had completely finished, and the pressure in the pressure valve had been completely released. Does that sound familiar? Because it should. Pictorially and graphically and in terms of price action, that's what it actually means mechanically when you get stopped out. When the move stops you just below your psychological or your mechanical level, and then it rips in rallies in the opposite direction. Every time you get wicked out and price reverses, this is what's happening. Miniature versions of the mechanism I just mentioned before, multiplied, amplified by millions of different trades each single day, just without the CNBC or the Bloomberg coverage actually telling you what's going on. This is the real mechanics of the market. Can't talk about these things without talking about the institutional flows. So let's get institutional. During monthly S&P option expirations, notional exposure often easily exceeds $2 to $3 trillion. Dealers have to hedge that dynamically, as I spoke about before. If they are short gamma, you know what happens. The price goes up, they have to buy. The price goes down, they have to sell. Just mechanically, just how the flows go. That creates an order flow in the market. That is pro-cyclical hedging, which can be front run and can actually work as running you over like a steamroller if you're on the wrong side of it, because it accelerates the move, it catalyzes the move, it adds fuel to the fire. If large open interest sits at 4,500 on the S&P, or like 7,000 where we are now, and price trades at, I don't know, 6,998, a sweep above 6,998 triggers. Stop buys, dealer hedge buys, all of the gammas explode, the momentum algos buy, all of the CTAs buy. Everyone has to get on board because algorithmically and because of the dealer book and the liquidity must transfer somewhere. Now, imagine that scenario in the reverse. When the liquidity above it clears, the path is thinned. The path thins out, the liquidity gets constrained again, and the vacuum happens all over again. So what happens to price? It completely starts to expand again. You weren't wrong, you weren't early, you weren't late, you were just the fuel. You were the accelerant, you were the petroleum, the kerosene, the gasoline that allowed the move to happen. Remember, the move has to happen with your stops. The markets don't hate you. The markets need you. The markets are using you as their fuel. And for those of you who say, it can't be us retail traders, we're insignificant. No, you're not. Insignificant money is no longer retail trading money. Retail traders are now moving the markets and getting things increasingly correct more than the big boys and the big girls in the hedge funds and on the street. The market doesn't crash because of the fear. It crashes because of the positioning math. And that's the unruly arithmetic truth of the numeracy. It's cold, it's hard, it's calculated, but it's pure positioning. I don't believe me, let's talk about another historical parallel. Volmageddon, 2018. 2018 in February, the VIX spiked over 115% in just one session. Inverse volatility products, XVI, overnight, they lost 90%. 90% overnight. Imagine waking up to that. But why? Well, because the short volatility trade was completely crowded. And when volatility rose even slightly, short vol funds had to hedge by buying volatility futures. That pushed the volatility even higher in a perverse, incestuous, self-fulfilling prophecy where everyone gets crushed and no one gets out in time. They pushed the volatility higher, which forced more hedging, convexity feedback loop over and over and over again until simultaneously everything gets triggered. All of the equity stocks get triggered. All of the derivatives priced to those exchange products get triggered until the liquidity is completely drained, the cascade feeds on itself, and then it resets back to 1. When the move completely reverses and they characterize it as a V-shaped recovery. Because essentially, graphically and pictorially, that's what the price action is doing. After everything is sucked out, after the vacuum is created, it has to go in the way that it goes. It has to V-bounce. Not because the fear disappeared, but because the inventory has to get transferred. And when the positioning clears out, expansion changes the direction. That's just the structural law, and that's how it always works, not just in big events like Volmageddons, or flash crashes, or GFCs, or Black Mondays, or Black Tuesdays, or Black Fridays, but in every single fractal picture of when you're trading in the market, and it goes across standard deviations that divert and diverge from the mean. It always happens that way. The sad thing is, boys and girls, our brains are not wired for that type of environment. Loss aversion research shows the same thing. A loss roughly feels 2 times as bad as a win. Okay, so the emotion, the dopamine, the serotonin, losing gives us more of an emotional pain than winning gives us an emotional feeling of relief and euphoria. You stop thinking probabilistically when you're in a loss. You start reacting defensively. Your stop widens, or you remove them, or you revenge trade, or you start to think that the market is wrong, or you start to think conspiratorially. But markets don't exploit emotional intentionality. They exploit predictability. And the predictable mind, our basal ganglias, our amygdalas, they're all trained to make us feel 2 times the pain when we're in a loss than the euphoria we feel when we're in a gain. So that means one thing: we are not thinking straight when we're in a drawdown. Your cluster stop, or our cluster stops, under the same lows as everyone else. We put our low levels of stops at the same level, at the previous lows. We act coordinatedly in a herd fashion because human psychology is such that it's so powerful that we all react the exact same way. And that's why these levels of support and resistance seem to attract magnetic forces of money on gargantuan proportion, because you are human, we are human, and markets are designed around the human clustering. I don't know what it is, but psychologically, something atavistically or anachronistically, we seem to cluster our stop levels, our fears, our supports, our resistances, our loves, our dreams around the exact same levels. And that's how our stops get exploited, and that's how it manifests as a V-bottom recovery or a sharp drawdown. That's exactly the mechanism behind it psychologically. It doesn't still explain why it feels like it's actually waiting for you, why it's targeting you. Well, I guess it's because we enter on a breakout. Breakouts form where liquidity has just cleared the moment before. But sometimes the breakout is engineered to clear the liquidity. It's not conspiracy, it's not fear-mongering. You place your stop at the last previous invalidation, which makes complete sense. But psychologically, it makes sense, but realistically and mechanically, it's making you cannon fodder. Invalidation is where everyone else also places their stop. So when price reaches that cluster, liquidity has to do one thing. It has to spike. And when liquidity spikes, you know what happens. The large players have to start transacting because that's the only way they can get filled. When they finish, the price starts to move. It doesn't wait for you, it waits for the completion. It waits for the big boys to get involved. You feel targeted because at the point of structural completion, you are actually the cannon fodder. So it makes sense that you feel targeted. It makes sense that you feel erroneously or egregiously that these big boys are stop hunting the little kids, the little boys in the market, the little girls in the market. But in reality, it's not that. It's a means, it's a necessity for them to be able to transact around those big order flows. Now, there's an inevitability to all of this. It's not going to stop. And that's a cold, hard truth, okay? As long as the stops exists, which are market orders that everyone can see, it's not going to stop. As long as the option market exists, again, it's not going to stop. As long as dealers can hedge dynamically, this kind of behavior is never going to stop. And as long as flows and order books can be observed on level 2 market data or whatever other platform that these people have psychologically, it's never ever going to stop because human beings are never going to change. It could be 2020, it could be 2200, it could be 3000, the year 4000. Humans are going to act like humans, and humans cluster around obvious levels for obvious reasons. Liquidity sweeps are therefore never anomalies. They are just the prerequisites of human behavior and the mechanical market taking advantage of it. The wick is not the noise, it's just the transfer. The transfer of one liquidity spigot to another liquidity spigot. The fake breakout is actually not deception. It's just the inventory clearing. You cannot eliminate the sweeps, but you can trade around them. You can think about them more cleverly, more intellectually, not being the cannon fodder that coalesces around the same stop level as everyone else. You can understand them, you can work around them, and you can be the people and the trader who doesn't actually succumb to them. And that's what changes your edge. Thinking differently, operating differently, but most importantly, understanding that that's how the mechanics of the system works. And once you understand the mechanics, you can fix any problem. My name's Justin Banton. Ciao for now.